Question 1. An investor writes an XYZ Jan 50 call for a premium of 3. If the writer is exercised when the stock is trading at 55, what is the outcome for the writer? A. A 2-point profit. B. A 2-point loss. C. A 3-point profit. D. A 5-point loss. Answer, B. A 2-point loss. The writer of the call received a premium of 3 but was obligated to sell the stock at the strike price of 50. Since the market price was 55, the writer had to buy the stock at 55 and sell it for 50, resulting in a 5-point loss on the stock transaction. However, this loss is offset by the 3-point premium originally received, leading to a net loss of 2 points. A simple tip is to always remember that for an option writer, the premium received reduces any loss or adds to any profit. Question 2. Under the Uniform Gifts to Minors Act, UGMA, when does the property in the account transfer to the minor? A. When the minor files their first tax return. B. At the age of majority in that state. C. When the custodian chooses to relinquish control. D. Upon the death of the donor. Answer, B. At the age of majority in that state. In an UGMA account, the assets are considered an irrevocable gift to the minor, but they are managed by a custodian until the minor reaches the age of majority. The specific age of majority varies by state but is typically 18 or 21. At that point, the custodian must turn over control of all the assets in the account to the former minor. The key takeaway is that UGMA assets belong to the child from day one, but control is delayed until they are legally an adult. Question 3. A corporation's board of directors has approved a 2-for-1 stock split. Which of the following is true for an investor who holds 100 shares of the stock before the split? A. The investor's total ownership value will double. B. The investor will own 200 shares, and the price per share will be halved. C. The investor will own 50 shares, and the price per share will double. D. The investor must pay a fee to receive the additional shares. Answer, B. The investor will own 200 shares, and the price per share will be halved. A stock split changes the number of shares outstanding and the market price of each share, but it does not change the total market value of an investor's position. In a 2-for-1 split, the number of shares doubles while the price per share is cut in half, leaving the investor's total equity unchanged. For example, owning 100 shares at $100 per share is a $10,000 position, which becomes 200 shares at $50 per share after the split, still a $10,000 position. Remember, a stock split is like cutting a pizza into more slices. You have more pieces, but you don't have more pizza. Question 4. An investor purchases a municipal bond in the secondary market at a price of 105. If the bond is held to maturity, what are the tax consequences of the premium paid? A. The premium is treated as a capital loss at maturity. B. The premium is deducted from ordinary income in the year of purchase. C. The premium must be amortized, reducing the cost basis, with no tax deduction. D. The premium can be ignored for tax purposes because the bond is tax exempt. Answer, C. The premium must be amortized, reducing the cost basis, with no tax deduction. For municipal bonds purchased at a premium, the IRS requires the premium to be amortized over the remaining life of the bond. This annual amortization reduces the bond's cost basis, but it is not a tax-deductible loss against ordinary income. At maturity, the investor's cost basis will have been reduced to par, resulting in no reportable capital loss. Think of amortization as a way to systematically adjust your cost basis down to par so there are no tax surprises when the bond matures. Question 5. Which of the following is an unregistered, non-exempt security sold under Regulation D of the Securities Act of 1933? A. An initial public offering of a technology company. B. A U.S. Treasury bond. C. A private placement. D. A municipal revenue bond. Answer, C. A private placement. Regulation D provides an exemption from the registration requirements of the Securities Act of 1933 for private placements. These offerings are made directly to a limited number of sophisticated or accredited investors, rather than to the general public. While the securities themselves are unregistered, they are still subject to anti-fraud provisions. This is a common way for companies to raise capital without the expense and time of a full public offering. Question 6. A customer places an order to buy 100 shares of ABC stock at 50 stop. This type of order is primarily used to A. Buy a security at a price below the current market price. B. Protect a profit on a long stock position. C. Limit a loss on a short stock position. D. Sell a security at a price above the current market price. Answer, C. Limit a loss on a short stock position. A buy-stop order is placed above the current market price and is triggered when the stock trades at or through the stop price. It is typically used to protect against losses in a short sale, where an investor profits from a decline in price. If the stock price rises instead, the buy-stop order is triggered, becoming a market order to buy and close out the short position, thereby limiting the investor's potential loss. An easy way to remember this is that you use a buy-stop to stop a loss when the market goes up on your short position. Question 7. A registered representative is reviewing a preliminary prospectus for a new issue. The document is missing the public offering price and underwriter's spread. This document is known as A. Final prospectus. B. Red herring. C. Offering circular. D. Trust indenture. Answer, B. Red herring. A preliminary prospectus, also known as a red herring, is an initial registration document filed with the SEC by a company preparing to issue new securities. It contains most of the key information about the offering but omits final details like the offering price and effective date, which are added in the final prospectus. The name comes from the red ink legend on its cover stating that the registration is not yet effective. Question 8. What is the primary investment objective of a growth fund? A. To provide a high level of current income. B. To preserve capital and offer high liquidity. C. To seek capital appreciation with little emphasis on income. D. To track the performance of a market index. Answer, C. To seek capital appreciation with little emphasis on income. A growth fund is a type of mutual fund that focuses on investing in companies with strong potential for capital appreciation, meaning an increase in the stock's price. These funds typically reinvest their earnings for expansion and research rather than paying them out as dividends, so they produce very little current income. Investors in growth funds are willing to take on higher risk in pursuit of significant long-term growth. Just remember the name itself, a growth fund is all about growing your initial investment. Question 9. In a firm commitment underwriting, who bears the financial risk if some of the securities in the offering go unsold? A. The issuing corporation. B. The underwriting syndicate. C. The transfer agent. D. The initial purchasers of the securities. Answer, B. The underwriting syndicate. In a firm commitment underwriting, the syndicate of investment banks agrees to purchase the entire issue of securities from the issuer and resell them to the public. The syndicate assumes the risk of being unable to sell all the shares at the offering price. If any shares remain unsold, the underwriters must absorb the loss, making it the riskiest type of underwriting for the investment bank. Think of it as the underwriters committing to buy the whole batch, for better or worse. Question 10. An investor buys an ABC May 70 put and pays a premium of 4. The investor will break even when the underlying stock is trading at what price? A. 66. B. 70. C. 74. D. 64. Answer. A. 66. The break-even point for the buyer of a put option is calculated by subtracting the premium from the strike price. In this case, the strike price is 70 and the premium paid is 4, so the break-even price is 66.74. At a stock price of 66, the investor can exercise the put, sell the stock for 70, and realize a 4-point gain that exactly offsets the 4-point premium paid to purchase the option. For put options, always think put down from the strike price to find your break-even. Question 11. Which of the following is a characteristic of a variable annuity accumulation unit? A. Its value is guaranteed by the insurance company. B. It represents an ownership interest in a separate account. C. It can be converted to a fixed number of annuity units at retirement. D. Its value remains constant until annuitization. Answer, B. It represents an ownership interest in a separate account. During the accumulation phase of a variable annuity, an investor's payments purchase accumulation units. The value of these units fluctuates daily based on the performance of the investments held in the separate account, which is a portfolio of securities like stocks and bonds. These units essentially represent the investor's ownership stake in the separate account's portfolio. Remember that variable means the value is not fixed and will change with the market performance of the underlying investments. Question 12. The Federal Reserve's Open Market Committee has decided to tighten the money supply. Which action would it most likely take? A. Lower the discount rate. B. Lower the reserve requirement for banks. C. Sell U.S. Treasury securities in the open market. D. Purchase U.S. Treasury securities in the open market. Answer, C. Sell U.S. Treasury securities in the open market. To tighten the money supply, the Federal Reserve wants to remove money from the banking system, which increases short-term interest rates. It accomplishes this by selling Treasury securities to primary dealer banks, which pay for these securities with funds from their reserves. This action reduces the amount of money banks have available to lend, thereby tightening credit and slowing economic activity. A simple way to remember is that when the Fed sells, money flows from the economy to the Fed, making money tighter. Question 13. Which of the following retirement plans is a defined benefit plan? A. 401(k) plan. B. Traditional IRA. C. Pension plan. D. SEP IRA. Answer, C. Pension plan. A defined benefit plan, such as a traditional pension plan, promises a specific retirement benefit to an employee, which is usually calculated based on factors like salary history and years of service. The employer is responsible for funding the plan and bears the investment risk to ensure the promised benefit can be paid. In contrast, plans like 401(k) are defined contribution plans, where the retirement outcome depends on the contributions made and the investment performance, with the employee bearing the risk. Question 14. An associated person is found to have violated FINRA rules. Under the Code of Procedure, which of the following is not a possible penalty that can be imposed by a hearing panel? A. A fine. B. Suspension of registration. C. A censure. D. A prison sentence. Answer, D. A prison sentence. FINRA's Code of Procedure outlines the process for handling rule violations, and a hearing panel can impose various sanctions, including fines, suspension or revocation of registration, and official censures. However, FINRA is a self-regulatory organization, not a court of law, and it does not have the authority to impose criminal penalties such as imprisonment. Criminal charges can only be brought by law enforcement agencies like the Department of Justice. Question 15. A customer wishes to give her registered representative discretionary authority over her account. Which of the following is required? A. A verbal agreement from the customer and approval from a principal. B. A written power of attorney signed by the customer and approval from a principal. C. Approval from the firm's compliance department only. D. A court order authorizing the representative to trade. Answer, B. A written power of attorney signed by the customer and approval from a principal. Discretionary authority allows a registered representative to place trades in a customer's account without consulting the customer on a trade-by-trade basis. To establish this authority, the customer must grant it in writing through a signed power of attorney. Additionally, a principal of the firm must review and approve the discretionary account before any trades can be made. Remember, when a representative can decide the asset, amount, or action, it's discretion, and that always requires written permission. Question 16. What type of risk are investors in U.S. Treasury securities primarily exposed to? A. Credit risk. B. Liquidity risk. C. Interest rate risk. D. Political risk. Answer, C. Interest rate risk. U.S. Treasury securities are backed by the full faith and credit of the U.S. government, making them virtually free of credit risk, or the risk of default. However, like all fixed-income securities, their market value is sensitive to changes in interest rates. If market interest rates rise, the value of existing, lower-yielding treasury bonds will fall, which is known as interest rate risk. This is the most significant risk for an investor holding these safe government securities. Question 17. Which of the following describes a closed-end investment company? A. It continuously offers new shares to the public. B. Its shares are redeemed by the fund at their net asset value. C. It has a fixed number of shares that trade on an exchange. D. It only invests in money market instruments. Answer, C. It has a fixed number of shares that trade on an exchange. A closed-end fund has a one-time initial public offering and then trades on a stock exchange just like a common stock. Unlike open-end funds, mutual funds, they do not continuously issue or redeem shares. Their market price is determined by supply and demand and can trade at a premium or a discount to their net asset value, NAV. Just think, closed means no new shares are created after the IPO. Question 18. From the perspective of the issuing corporation, what is a primary advantage of issuing convertible bonds? A. They can be issued at a higher interest rate than non-convertible bonds. B. They allow the issuer to sell debt with a lower coupon and potentially raise equity in the future. C. They provide the corporation with a guaranteed source of short-term funding. D. They are considered senior to all other forms of debt in a liquidation. Answer, B. They allow the issuer to sell debt with a lower coupon and potentially raise equity in the future. Corporations issue convertible bonds to lower their cost of borrowing. Investors are willing to accept a lower interest rate, coupon, in exchange for the opportunity to convert the bond into common stock and participate in the company's growth. This feature benefits the issuer by reducing interest expense and, if converted, turns debt into equity on the balance sheet without a new stock offering. It's a way for a company to get cheaper debt now with the possibility of issuing stock later at a premium. Question 19. A registered representative recommends a variable universal life insurance policy to a 75-year-old client seeking a stable source of retirement income. This recommendation would most likely be considered A. Suitable, due to the policy's tax-deferred growth. B. Unsuitable, due to the high fees and market risk. C. Suitable, as it offers a flexible death benefit. D. Unsuitable, as the client is too young for this product. Answer, B. Unsuitable, due to the high fees and market risk. A variable universal life, VUL, policy is a complex product with investment risk and typically high fees and surrender charges, making it inappropriate for a senior investor seeking stable income. Suitability rules require that recommendations align with a client's age, financial situation, and investment objectives. Recommending a high-risk, long-term product to an elderly client needing income is a classic example of an unsuitable recommendation. The key is to match the product's features with the customer's needs and risk tolerance. Question 20. A corporation issues bonds that are backed by the full faith and credit of the company and its general assets. These bonds are known as A. Mortgage bonds. B. Collateral trust bonds. C. Debentures. D. Equipment trust certificates. Answer, C. Debentures. A debenture is an unsecured corporate bond, meaning it is not backed by any specific collateral or asset. Instead, it is backed only by the general creditworthiness and reputation of the issuing corporation. In the event of a liquidation, debenture holders have a claim on assets only after secured bondholders, such as those holding mortgage bonds, have been paid. For this reason, debentures carry more credit risk than secured bonds. Question 21. Which U.S. government agency guarantees the payment of principal and interest on pass-through securities issued by approved lenders? A. Federal National Mortgage Association, Fannie Mae. B. Government National Mortgage Association, Ginnie Mae. C. Federal Home Loan Mortgage Corporation, Freddie Mac. D. Federal Deposit Insurance Corporation, FDIC. Answer, B. Government National Mortgage Association, Ginnie Mae. The Government National Mortgage Association, Ginnie Mae, is a government-owned corporation that guarantees the timely payment of principal and interest on mortgage-backed securities, MBS, issued by private lenders. This guarantee is backed by the full faith and credit of the U.S. government, making Ginnie Mae securities very safe from default risk. Unlike Fannie Mae and Freddie Mac, which are government-sponsored enterprises, Ginnie Mae has the explicit backing of the U.S. government. Question 22. A customer complaint has been received by a brokerage firm. According to FINRA rules, a copy of this complaint must be maintained in a file for how long? A. 1 year. B. 3 years. C. 4 years. D. 6 years. Answer, C. 4 years. FINRA rules require that all written customer complaints and records of any action taken in response must be kept for a minimum of 4 years. This record-keeping requirement ensures that firms maintain a history of customer grievances, which is subject to review during regulatory examinations. For record retention, remember that most general records are 3 years, but key items like customer complaints and trade confirmations have different time frames, with complaints being 4 years. Question 23. An investor in a high tax bracket is seeking tax-advantaged income and is willing to take on significant risk, including the potential loss of their entire investment. Which of the following would be the most suitable recommendation? A. AUS. Treasury bond. B. A blue-chip common stock. C. An oil and gas limited partnership. D. A money market mutual fund. Answer, C. An oil and gas limited partnership. An oil and gas limited partnership, a type of direct participation program, DPP, is a high-risk investment that offers potential tax advantages, such as pass-through depletion and depreciation deductions. These programs are generally suitable only for sophisticated, high-net-worth investors who can withstand the risks of illiquidity and potential loss of principal. The other options are far too conservative to meet the investor's stated risk tolerance and objectives. Question 24. A client buys 100 shares of stock at $60 per share and simultaneously buys a 6-month put option with a strike price of $60 for a premium of $4. What is the client's maximum potential gain? A. $5,600. B. $6,000. C. $400. D. Unlimited. Answer, D. Unlimited. This strategy is a protective put, where an investor buys a stock and a put option on that stock to hedge against a decline in value. While the put protects the downside, the upside potential from the long stock position remains unlimited because there is no theoretical limit to how high the stock price can rise. The cost of the put option will reduce the total profit, but it does not cap the potential gain. Remember, when you own a stock, your potential profit is always unlimited unless you've also sold a call against it. Question 25. Under MSRB rules, which of the following is considered advertising? A. An official statement. B. A preliminary official statement. C. A summary of an official statement prepared by a dealer. D. A legal opinion from bond counsel. Answer, C. A summary of an official statement prepared by a dealer. MSRB rules define advertising as any material, other than listings of offerings, published or used in any electronic or other public media, or any written or electronic promotional literature distributed to customers. While official statements are disclosure documents created by the issuer, any summary or abstract prepared by a dealer for promotional purposes is considered advertising. This means it is subject to MSRB rules requiring that it be fair, balanced, and not misleading, and must be approved by a principal. Question 26. A registered representative wants to participate in a private securities transaction for a company owned by her brother. What must she do first? A. Obtain pre-approval from the firm's compliance department. B. Notify her branch manager after the transaction is complete. C. Provide written notice to her employing firm. D. Resign from her position at the firm. Answer, C. Provide written notice to her employing firm. This situation describes selling away, where a registered representative engages in a private securities transaction outside of their employing firm. FINRA rules require the representative to provide prior written notice to their firm describing the proposed transaction and their role. If the representative is to receive compensation, the firm must then approve the transaction in writing and record it on its books and records. Simply providing notice is the first critical step. Question 27. The primary difference between a traditional IRA and a Roth IRA is the A. Contribution limits. B. Type of investments allowed. C. Tax treatment of contributions and withdrawals. D. Age at which required minimum distributions must begin. Answer, C. The tax treatment of contributions and withdrawals. The main distinction between a traditional IRA and a Roth IRA lies in their tax structure. Contributions to a traditional IRA are often tax-deductible, and withdrawals in retirement are taxed as ordinary income. In contrast, contributions to a Roth IRA are made with after-tax dollars, not deductible, but qualified withdrawals in retirement are completely tax-free. Think of it as choosing when to pay your taxes, Pay them now with a Roth, or pay them later with a traditional IRA. Question 28. Which order would an investor use to buy a stock at a specific price or lower? A. Market order. B. Limit order. C. Stop order. D. Stop limit order. Answer, B. Limit order. A limit order is an order to buy or sell a security at a specific price or better. For a buy limit order, better means a lower price, so the order will only execute at the limit price or below it. This gives the investor control over the price they pay but carries the risk that the order may never be filled if the market price does not reach the specified limit. Use a limit order when the price you pay is more important than the certainty of execution. Question 29. A financial analyst describes a stock as having a beta of less than 1.0. This indicates that the stock is expected to A. Be more volatile than the overall market. B. Be less volatile than the overall market. C. Perfectly mirror the performance of the overall market. D. Perform independently of the overall market. Answer, B. Be less volatile than the overall market. Beta is a measure of a stock's volatility relative to the broader market, which is assigned a beta of 1.0. A stock with a beta of less than 1.0 is expected to be less volatile, meaning it will likely rise less than the market in an upswing and fall less in a downturn. For example, utility and consumer staples stocks often have low betas because their business is less sensitive to economic cycles. Think of a low beta stock as being in the slow lane while the market is on the highway. Question 30. An order that must be executed in its entirety immediately or be cancelled is A. Market order. B. All or none, AON, order. C. Immediate or cancel, IOC, order. D. Fill or kill, FOK, order. Answer, D. Fill or kill, FOK, order. A fill or kill, FOK, order is a time-in-force instruction that requires the order to be executed immediately and completely or not at all. If the entire size of the order cannot be filled at once, the whole order is cancelled. This differs from an immediate or cancel, IOC, order, which allows for partial execution, with the unfilled portion being cancelled. An FOK is used when an investor wants to ensure they get the entire position at the current price, without any partial fills. Question 31. Which of the following securities is most likely to be quoted on a yield basis? A. Common stock. B. Preferred stock. C. A serial municipal bond. D. A stock option. Answer, C. A serial municipal bond. Serial bonds, which are bonds that mature in installments over a period of years, are typically quoted on a yield-to-maturity, YTM, basis rather than a dollar price. This is because each maturity in the series will have a different yield. Quoting on a yield basis allows investors to easily compare bonds with different coupon rates, maturities, and dollar prices. Equities and options are quoted in dollar prices. Question 32. According to Regulation T, what is the initial margin requirement for corporate securities purchased in a margin account? A. 25%. B. 50%. C. 75%. D. 100%. Answer, B. 50%. Regulation T of the Federal Reserve Board establishes the initial margin requirement for equity securities, which is currently 50% of the purchase price. This means an investor must deposit at least 50% of the value of the securities they wish to purchase on margin, and they can borrow the remaining 50% from their brokerage firm. This rule helps ensure that investors have sufficient equity in their accounts to cover potential losses. Question 33. A customer is interested in an investment that offers exposure to the real estate market but provides more liquidity than owning property directly. Which of the following would be a suitable recommendation? A. A real estate limited partnership, RELP. B. A real estate investment trust, REIT. C. A collateralized mortgage obligation, CMO. D. A mortgage bond. Answer, B. A real estate investment trust, REIT. A real estate investment trust, REIT, is a company that owns, operates, or finances income-producing real estate, and its shares typically trade on a public stock exchange. This structure provides investors with a way to invest in a portfolio of real estate assets while enjoying the liquidity of a publicly traded stock. In contrast, RELPs are illiquid, and CMOs and mortgage bonds are debt instruments, not equity investments in property. For liquidity in real estate, REITs are the go-to investment. Question 34. The spread in an options transaction represents the difference between the A. Strike price and the market price of the underlying security. B. Purchase of one option and the sale of another. C. Bid and ask price of the option contract. D. Highest and lowest price of the option during the day. Answer, B. The purchase of one option and the sale of another. In options terminology, a spread is an advanced strategy that involves the simultaneous purchase of one option and sale of another option of the same class but with different strike prices, expiration dates, or both. This is done to limit risk, but it also limits the potential profit. The other choices describe intrinsic value, the bid-ask spread, and the daily price range, which are different concepts. Question 35. What is the tax treatment for the annual accretion of an original issue discount, OID, on a municipal bond? A. It is taxed as ordinary income each year. B. It is treated as tax-exempt interest income. C. It is taxed as a capital gain at maturity. D. It is deferred and taxed as ordinary income at maturity. Answer, B. It is treated as tax-exempt interest income. An original issue discount, OID, occurs when a bond is first sold for less than its par value. For a municipal OID bond, the discount must be accreted annually, and this accreted amount is considered tax-exempt interest, just like the bond's stated coupon payments. This annual accretion also increases the bond's cost basis, so at maturity, there is no reportable capital gain. This is a key tax benefit, as it distinguishes municipal OIDs from corporate OIDs, where the accretion is taxable.